Virtu Financial. In 2024, this company generated $1.8 billion in net trading income, not from managing your portfolio, not from selling you investment advice, from one activity, standing in the middle of every trade you made and collecting a toll both ways. Every time you bought Bitcoin, there's a real chance Virtu was on the other side selling it to you. Every time you sold, they bought. 5.3 million times a day, across more than 35 countries and 235 trading venues. The question isn't whether they win, they clearly win. The question is how a firm that loses money on nearly half of every individual trade still clears almost $2 billion a year. That's what this episode is about. In episode 1, we established that every trade you make carries a hidden cost, the spread, price impact, and adverse selection. Today's question: who is on the other side collecting that? Your broker routes the order. The exchange matches it. But the market maker is the one physically committing capital, showing up to buy what you want to sell or sell what you want to buy at any given moment on demand. That's a service with real financial risk attached to it. In return, they collect a toll. That toll is the spread. In U.S. equities, Citadel Securities handles approximately 35 to 40% of all U.S. retail equity trades on a typical day, according to their own disclosures and SEC Rule 606 filings. Virtu Financial accounts for most of the remainder of what's called the wholesale market-making space. In crypto, the equivalent firms are Wintermute, Jump Crypto, and GSR Markets. You never see their name on the order. They're present in the order book of every major exchange, quoting prices around the clock. So, market makers are not a niche, they are the infrastructure. Now let's look at how the economics actually work. Here is the single most counterintuitive fact about market making. Virtu Financial, in their own SEC IPO prospectus from 2015, disclosed that they profitably exit only 49% of their positions. The rest are losses or break-even. Astrophysicist Gregory Laughlin at UC Santa Cruz analyzed the data further and found that the number of break-even trades is roughly equal to the number of losses, meaning the true win rate on individual trades is somewhere around 51 to 52%. On any single flip, any single trade, the edge is almost invisible. But the 51-49 split applied across millions of trades per day becomes something different. Let's do the math. Virtu's adjusted net trading income for 2024 was $1.597 billion. That's revenue after directly attributable trading costs, verified in their SEC filing. Divide by 252 trading days, divide by 5.3 million daily trades. You get roughly 1/5 of a cent per trade. That number sounds laughably small, but the volume is not 1,000 trades. It is 5,300,000 trades every single trading day across thousands of instruments. The gap between the theoretical ceiling and the real number is real friction. Transaction costs, hedging, technology infrastructure, data fees, and personnel. The business model isn't frictionless, but the scale of the volume makes small per-trade margins into institutional profit. Every time a market maker sells Bitcoin to you, they now hold a short position. Every time they buy from you, they hold a long position. They didn't want that position. They had no opinion on where Bitcoin is going. They simply agreed to be on the other side of your trade. Over time, if buy orders and sell orders arrive perfectly balanced, no problem. They buy low, sell high, collect the spread, close out. But order flow is never perfectly balanced. Trends develop. Orders cluster. The market maker's inventory drifts. That's inventory risk. Every unit of inventory the market maker holds is directional exposure they didn't request. If they are sitting long on 30 Bitcoin and price drops 2%, that's $1,800 in unrealized loss before they've earned a single dollar of spread. In 2008, Marco Avellaneda and Sasha Stoikov published a paper that formalized the market maker's optimization problem mathematically. The model has two outputs, a reservation price and an optimal bid-ask spread. Both depend on inventory. The reservation price is the market maker's internal valuation, not what the market says the asset is worth, but what it's worth to them, given their current position. If you're long 20 Bitcoin at a $100,000 mid-price with a risk aversion parameter of 0.1 and half a trading day remaining, the Avellaneda Stoikov formula puts your reservation price roughly $40 below market. You're biased to sell, not buy. The optimal spread formula has two terms. The first is an inventory risk component. It widens your spread when you're holding more volatile inventory for longer. The second is an order arrival component, which depends on how dense the order book is around you. The important implication, spread width in crypto is not random and it is not greed. It is a mathematical response to volatility, inventory exposure, and order book depth. When you see a cryptocurrency spread suddenly widen, that is a market maker solving this equation in real time under changed conditions. Watch what happens when the market maker is long. Their ask price drops, making it slightly cheaper to buy from them, while their bid price also drops, making it slightly worse to sell to them. They're leaning their quotes to encourage exactly the flow that unwinds their inventory position. This is why price sometimes drifts without any visible news or catalyst. You are watching the aggregate effect of market makers rebalancing their books. Simultaneously, across dozens of exchanges, it looks like price action. It is, in part, inventory management. Now, the system we just described works beautifully under one condition, that the people trading against the market maker don't know anything the market maker doesn't. But what happens when they do? Every person who trades with a market maker falls into one of two categories. Noise traders, sometimes called liquidity traders, are trading for their own reasons. They need cash. They're rebalancing. They got paid and want to buy some Bitcoin. They have no edge on price direction. The market maker collects the spread on every one of these interactions. Informed traders are different. They know something. Maybe they've spotted a large institutional order about to hit the book. Maybe they've analyzed on-chain flows that precede a price move. Whatever the edge, they are trading because they know the price is about to move in a specific direction, and the market maker must sell to them. They can't check. Here is the adverse selection problem quantified. In that simulation, 85 noise traders generate $255 in spread revenue. 15 informed traders generate $210 in losses. The market maker is net positive, but only barely, and this is with a 15% informed trader ratio, which is actually on the lower end for crypto. The key insight: the bid-ask spread is not arbitrary profit extraction. It is the market maker's break-even calculation for operating in an environment where some fraction of the people trading against them know more than they do. Research from Cornell measured the VPN, the volume-synchronized probability of informed trading, across crypto and traditional markets. The E-mini-S and P500 futures, one of the deepest and most liquid instruments in the world, runs at a VPN of roughly 0.22 to 0.23. Bitcoin and Ethereum run at 0.45 to 0.47. Crypto order flow is approximately twice as toxic as the most liquid traditional futures market. This directly explains why crypto spreads are structurally wider than they would be in a market dominated by noise traders. The market maker is pricing in a much higher expected loss per interaction with informed flow. We'll go deep on VPN, what it measures, how it's calculated, and what it means for market crashes in Episode 3. Let's bring this back to the question that actually matters to you as a trader or investor. Takeaway 1. A spread is not static noise. When you see the spread on a Bitcoin pair suddenly widen, that is the market maker detecting a change in their environment. The spread is the signal. Takeaway 2. When you place a limit order, you flip from taker to maker. You post a bid or ask in the book, and if it gets hit, you collect the spread instead of paying it. The trade-off is execution risk. Your order might not fill, but over enough trades, the difference compounds. Takeaway 3. Market makers are infrastructure. The spread you pay is the price of getting your trade done immediately against a guaranteed counterparty at a publicly visible price. In U.S. equities, typical spreads in the 1990s were 12.5 cents. Today, they're under 1 cent in liquid names. Market-making competition reduced that cost by over 90%. The cost is not zero, but the counterfactual is more expensive. To summarize the core concepts, market makers are risk-bearing infrastructure, not passive intermediaries. The Virtu paradox is that they lose on roughly half of trades and still clear $1.6 billion a year via scale. Inventory risk is the core operational problem of market making. Informed traders are the enemy, and spread is the insurance, and limit orders flip your role from taker to maker. We've established who market makers are, how their economics work, and what breaks the model. The number I glossed over in segment 4, the 0.46 versus 0.23 VPIN comparison, is the thread into episode 3. VPIN measures the toxicity of order flow in real time. The probability that whoever is trading with the market maker knows something the market maker doesn't. In the next episode, what exactly VPIN is, how it's calculated, what the academic evidence actually says about its predictive power, and where it fails. The full picture. No overclaims.